Welcome to the second part of our discussion today on Module 7. This is Chapter 20 now. We are talking about the working capital management. Most of our day-to-day things, is covered by our working capital. So this covers a very, very important part of corporate finance, working capital management. And we'll go over this. So we'll talk about different aspects of working capital management. Excuse me. The first is talking about accounts receivable. What are our important working capital issues? Accounts receivable, managing accounts receivable, managing inventory, managing cash. These are some important issues in working capital management. So we'll focus on these important accounts. Then, of course, you have investments. Marketable securities are another aspect of your working capital management, temporary investments. We'll talk about investing, idle cash and the money market in this. So first part is managing accounts receivable and credit policy. So we'll focus on that. Managing your accounts receivables and credits, it involves 5 steps. Remember, credit is an investment that you make. You make an investment in the hope that there will be more business, there will be return. Because when you extend credit, you are investing money. So you have to invest it very carefully. Your credit. The first important step in credit management is to establish the terms of sale. How are you going to give the credit? So the terms of sale. And we'll talk about each one in detail. The second one is in what form, So your contract, IOU, you'll have a contract. So what form we'll give? We'll go over that. Then who to give credit to, So we have to conduct a credit analysis. That is important, And then you have to have a policy, how long credit you will give for, Those kinds of things, rules to determine whether or not credit should be extended and for how long it should be extended. These are all part of your credit policy. And you have to base your policy on good credit analysis. Once you have established your credit policy and the credit is being given, then you have to make sure that you receive your money back and collect it fast also. To maintain your liquidity. So developing a good collection policy, that is another part of your credit management and your, credit management strategy. So these are 5 things we have to cover, and we'll cover each one step by step when we are talking of credit management. So the first thing is some terms here for you to understand. Trade credit. When we give trade credit, what is trade credit? When you are extending credit to companies who pay you, say, once a month, right? So once a month they pay you, you have a contract with them. That is called giving trade credit. Giving bills are awaiting payment from one company to another, So you extend credit, say, to IBM. IBM has credit or Microsoft has credit with you, and they pay you once a month for their whatever the services they take from you. So that is trade credit. Consumer credit is another way, where bills, when we extend credit on a retail basis to customers, right? One-on-one. So bills are awaiting payment from the final customer to the company. Okay. So this is consumer credit. And then terms of sale, another term, 210 net 30, 510 net 30. What are these? These are terms on which you extend credit. So when I say we'll go over these, 210 net 30, that means 2% discount if you pay within 10 days, the net is due in 30 days. Those are terms of sale. Okay. How much credit, how much cash, all those things. What are the payment terms offered on the sale? All these things are very important, for us to talk about. Okay. So another related to this, say another term, COD, cash on delivery. When you are extending credit to somebody who, first of all, they don't have good credit history or whatever it is, then you will always see this kind of a term, COD, cash on delivery. That means we will, as soon as the goods are delivered to you, you have to pay cash. Okay, you have to pay cash. Is also check is also cash. In cash now we'll see in cash management so many alternatives nowadays. But so COD. Another is cash before delivery. It's the most restrictive terms of sale. We are talking of terms of sale over here. So that is the first aspect of a credit policy. So when you're extending credit, cash before delivery, when does this happen? Number one, if the delivery amount, the consignment is very large and it involves a lot of capital on your side also. So you take an order, you take a purchase order, and it's for a huge purchase order, and you need capital for that. So cash before delivery, you will need from them. Though that is one way. It's a very, very restrictive thing. That means the customer has to pay you before, and then you develop the product and you deliver it. So that is, again, and sometimes even when the credit is bad, that and then also we do it. But this is most restrictive, CBD. Then we have on credit. So that is when we have one example would be end of the month, EOM example. So EOM, end of the month, 210 net 30. Okay. So these are some examples. End of the month example over here is, okay. Here also you will have 210 EOM net 30, you will say. So you say, if you pay 10 days before the end of the month for this is not just 210 net 30. Remember, this is different. 210 net 30 is 2% discount if you pay within 10 days and the net amount is due in 30 days. But EOM means that you have to pay by the end of the month. Now you can combine these two and say, okay, 210 EOM net 30, okay, or net 60. 210 EOM net 60. So then in that case, the end of the month will come, kick in first, and you will say that, okay, I will give you 2% discount if you pay 10 days before the end of the month. Otherwise, the next net amount is due in, say, 60 days, 210 net 60. So you can have a combination of these also. Okay. So there is no restriction to this. There is no fixed way. You can create more and more, and especially in finance, they come up with new ways every day. So, example here, total bill is $75,000 and the term is 210 net 30. Okay. So what does this mean? This means that you'll get 2% discount for early payment. 10 stands for number of days that the discount is available. So if you pay by 10 days, within 10 days, you'll get 2% discount. Okay. Otherwise, the entire amount is due within 30 days. Number of days before payment is due 30. So this is what it means. So here, there are some financial implications. You know, on days 1 through 10, how much will you pay? You will pay 73,500 and not 75,000. So that means 2% discount you will have if you pay on days 1 to 10. Now, for the next 20 days, you will pay 75K. Do you understand? So, there is a financial implication of it. In fact, the firm is telling you that if you don't take this discount of 2% now, when you'll get by just with 73.5, if you don't make use of this, you are borrowing the additional amount for 20 more days. So it comes to an exorbitant amount of interest rate that you are paying. So if you have the money, take it always. Take this, So a firm that buys on credit is in effect borrowing from its supplier. We know that, right? And it saves cash today, but will have to pay later, right? With the discount terms. And this is an implicit loan from the supplier that this person is taking, that you are taking. Now, this implicit cost of this loan, if you determine, it will come to your effective annual rate of 1 plus the discount over discounted price to the power 365 divided by the extra credit days, that is 20 days over here in this case, minus 1. The discount over discount price, that is the rate, that is the R we take for this. So let's apply this and you'll understand. So there is a sale of $100, that is to keep things simple, with term 5, 10, net 60. What is the implied interest rate on the credit given? Quite a bit, it's 45% here. You will see. One effective annual rate will be 1 plus the discount over discounted price. My discount is 5%. So 5 divided by my discounted price. My discounted price is 100 minus $5, $95. So discounted price is $95 over here. And to the power of how many extra days do I get? Well, if I pay, my net is 60 days. And so the extra days that I'm borrowing the money, if I'm not paying this, getting this discount, so the extra days is 60 minus 10 is 50 days. So 360, that means 365 divided by 50 periods. For so many periods I have, time periods. So 365 divided by 50 is the power over here. And if you complete this, you'll find it's 45.4% is the implied interest rate on the credit given. You can do the same for other examples, and you will see that it comes to quite a bit, especially if the, if the time is less, if net is 30, if the net is 30, then what will happen is, this 50 over here will become 30 minus 10 is 20. So the power will increase multiple times. So it will come to a lot, more. So you have to understand, moral of the story is whenever you have these kinds of opportunities and you have the cash to pay, then you will save a lot of money. Just take the discount. The second part of your credit policy, making the credit policy, the credit agreements that you come up with. Okay. So some terms and terminologies for this that you have to be aware of. Open account. What is an open account? And these you can go through in your book, the definitions. The open account is for all the retail customers, who can pay you on credit. It's an open account. You don't have to sign contract for that. So if you have an account, open account with your supplier, you can keep borrowing. And when you buy things and pay at the end of the month, you're borrowing money actually, and it is open. So the more you buy, the more you're borrowing. The more raw material you're buying, the more you're borrowing, in an open account. The other thing is a promissory note where you have to sign an IOU, Then you have commercial drafts, side drafts, time drafts, where you give them, the customer is supposed to deposit a draft to the bank, okay? And the bank will release the draft to the, for payment to you, depending upon the time of the draft. So, bank draft, these are all different drafts that you have. So go through these definitions. What is a trade acceptance? What is a banker's acceptance? These are just definitions, just terminologies, credit, agreements, basic things. You can just go through those in your definitions. So again, these are different kinds of agreements. These are more and more restrictive. Open account is the most open. Then you have the promissory note. Then you have the commercial draft, side draft, time draft. Here the money is taken from your account to the bank and is submitted there as a draft. And the draft is then, like when you buy real estate, you have to sign and keep it there, right? And then it is given at the end. So then you have the trade acceptances, bankers acceptances. These are all, more and more and more and more restrictive as we go. Then just some explanations of these. The open account agreement whereby sales are made with no formal debt contract, as I mentioned earlier. You got to have, like this, you'll have definitions of others. Credit analysis is very important, is the third phase in your credit policy. And credit management. What we do here is we determine the likelihood that a customer is going to pay his or her bills. And we make use of credit agencies such as Dun and Bradstreet and such others, and they will provide you with the credit worthiness of the companies that are candidates for your credit. Okay, and you can also do it on your own by calculating the financial ratios. And we'll go through these as we are moving along. Once you do all these things, and when Altman's Z-score is there, and we'll go through some examples, you will see that then you start ranking these customers based on the score the credit score that you create, that you get. You go through credit agencies, right? Equifax and so on and so on. So they'll give you a credit score. That is one way of your credit scoring, right? So the FICO score that we are talking about, which is a combination of 3 different credit scores, TransUnion, Equifax, and all those 3. So those are scores you obtain from companies. So based on all those, then you will characterize. You go through the 5 C's of credit over here. These are very important in scoring, your final scoring. First C is character. How many defaults, past default the customer had. Then the capacity to pay, whether they have the income, they have the revenues, right? Then the customer's capital, how much capital are they sitting on? What is the size of their business? Then how much collateral is provided? Sometimes they provide collateral, right? So how much collateral is provided by the customer in the deal? More collateral, more credit I'll give. Okay. So secured loans, these are secured loans. And then the condition of the customer's business. Okay. Whether it is, thriving, doing well, or it is doing very bad. And you will see that there are different ways of rating them. Companies that are doing bad, you can easily see from their scores, that they're doing bad. So you have Altman Z score is a very common, very old technique. and based on discriminant analysis. But there are other scores also. There's another score that is discussed in your book. You can go through that. But I will go over this old accepted technique, the Altman Z-score, where you measure the company's solvency, whether it is you can give credit to this company or not. And they use discriminant analysis, in the paper, and they're able to identify bankrupt firms approximately 95% of the time. So that was Altman's Z-score, and he came up with this is a discriminant analysis, loadings, these factor loadings they do. So the maximum load was on EBIT over total sales, the 3.3, and then 1 times the sales over total assets, sales as a percentage of total assets. Then 0.6 loading on market value of equity to book value of debt, and then 1.4 loading on retained earnings to total assets. So what is the plowback ratio, and 1.2 loading on a working capital ratio of total assets. How much working capital as a percentage of total assets? So this was, they plugged in, and they could predict 95% of times the bankruptcy, the likelihood that the company will go bankrupt. Okay, so here is an example. If the Altman Z-score, normally over here, they found that overall, if the Z-score is 2.7 and above, then that it's an acceptable Z-score. Below 2.7, it is a bad Z-score. Okay, so this is what they found. So here, if Altman's Z-score cutoff for a credit-worthy business is 2.7 or higher, would we accept the following client? So they've given the Z-score is 3.04 based on the ratios over here, 3.04. We find that the score is above 2.7, so it indicates good credit according to Altman's Z-score. Now, again, this is not the ultimate. Okay, nowadays there are other techniques also, that there are scoring techniques that people use, and I told you the FICO and all those things they are using for the credit worthiness. And now you have so many companies that report your credit scores. So that is equally important. So keep those in mind. So this way you analyze the credit, and credit analysis is only worthwhile if the expected savings exceed the cost. If you're spending too much on it and you don't get enough gains, then it is not worth it. So don't undertake a full credit analysis unless the order is big enough to justify it. This is the moral of the story. And undertake a full credit analysis for doubtful orders only. So more money you can only spend if it's a big order and very doubtful order. Okay? So once you do all those things, then you make your credit decision. Okay, I will give credit to this company. So you start setting your credit policy, your standards to determine how much, and what kind of credit, how long a credit to extend to the customer. What will be your credit limit? How long will be your payment terms, right? The credit scoring over here is something that, the ranking that you give, your lender basically will tell you that, yeah, this is what it is, you are in this range, and this way and that way. Nowadays, there is disclosure principle. So they give you will receive a report about when you're looking for somebody's credit, you'll receive a report, and that person will get a report too. So it is, there are laws guiding this now. It's not that what your lender won't tell you. You have to monitor them as much as you can. Extending credit gives you the probability of making a profit, not the guarantee. There is still a chance of default over here. Yes, there is always a chance of default. And denying credit guarantees neither profit nor loss. Okay, so because you haven't taken a chance here. So what you do is make decision trees. So to make a credit decision, first of all, the first thing is, do I give credit or do I not give credit, right? So offer credit or don't offer credit, right? So if you don't offer credit, then the payoff is zero anyway. But if you offer credit, then you have again two options. Either the customer will pay with a probability of P, or the customer will default with a probability of 1 minus P, right? The maximum is 1 probability, 100%. So now, if the customer defaults as 1 minus P probability, then the payoff, what is the payoff? It is the cost, right? The payoff is your cost. This is the cost that you extended credit, the cost of all that involved, the opportunity cost of giving credit, to that customer, and that cost is what you lost. But if the customer pays, and of course the probability expected value of that is 1 minus P times the cost, right? That is expected value. Probability times the cost is expected value. And then the customer pays, then the payoff is what? Your profit. Your revenue minus your cost is your profit. So the expected profit is P times the revenue minus your cost. And the loss over expected loss is 1 minus P times your minus cost. So the expected value, if you offer credit, will be, the net will be what? P times revenue minus cost, which is your P times profit, and minus the cost over here. So this is a minus 1 minus P times the cost. That will be the expected. And otherwise, if you refuse credit, it will be 0. So you make decision trees like that and you calculate the expected values and go for the best. Some things to remember in credit decision. Number 1, remember to maximize. Credit is an investment that you are making. So you have to keep an eye on your profits, maximize the profit, only give credit where it will improve your business and your profits. Concentrate on dangerous accounts. If there are dangerous accounts, then you have to investigate properly and make sure that you analyze it thoroughly. And sometimes you have to have a future focus and have a strategic focus and look beyond the immediate order. So as they say that if there is a more long-term gain, short-term pain and long-term gain, go for that, right? So that is very important. These things you have to remember for credit. Now, the final part of credit management is your collection policy. Make sure that after you have extended your credit, you collect your money fast so that your cash flows are not affected adversely. So what is collection policy? The 5th prong of your credit management is collection policy, all the procedures to collect and monitor all your account receivables. So this includes creating an aging of accounts schedule, breakdown of accounts receivable according to length of time outstanding, to track who is good, who is bad. Here is an example of aging schedule, for your accounts receivables, where you are seeing very clearly that, when you go more than 3 months old accounts here, customer Z, more than 3 months old, total owed 30,000. This is, customer Z is gone case here. 5,000 less than a month, 4,000, 1 to 2 months. The more than 3 months is 15,000 over here. So you know how to track the bad accounts, okay? From less than a month to more than 3 months old and more old. These are bad investments. So that will help you track statement of aging of account. So that much about your credit policy and credit management. The first part, how to manage your accounts receivables. Okay. The second important account is your inventory, how to manage the inventory and the EOQ model and those kinds of things. Just-in-time inventory. So inventory management the second part. And the goal over here is to minimize the amount of cash tied up in inventory. So you don't want to hoard or store a lot of inventory and have lazy assets sitting and they don't sell. So the goal is to minimize that. And there are models to do that. Remember that as the firm increases the size of the order due to economy of scale, the number of orders fall, and therefore the order costs will go down. So instead of buying every day, so many orders you make and each order costs you money. So if you increase the size of the order, then you get the economy of scale and the number of order falls and the order costs will decline. The second thing is, in relation to this, remember that increase in order size also increases the average amount of the inventory. So the carrying cost of the inventory also goes up. You have to store the inventory. So storage cost, insurance, all those kinds will go up. So that is the carrying cost goes up if the order size increases. And if the order size increases, then the number of orders falls and the cost per order that declines. So the trick over here for us in inventory management is to strike a balance between these two costs. The order costs and the carrying cost of the inventory. And the simplest inventory model is the sawtooth model. Now in this, we assume that, okay, inventory in thousands of units we put on y-axis and weeks, the time on the x-axis. Then over here, we assume that as we let's say we need 60 units of inventory this period, okay, for 3 weeks. So we buy, my average inventory is 30, but I need 60 maximum, over a 3-week period, and it goes. So I buy my 60 and then I use it for 3 weeks and it comes to 0. Then I reorder, I'm restocking 60 units. And then again, I use it over 3 weeks. This is the simplest kind of inventory model. If you look at the average is, 0 to 60 divided by 2 is 30, right in the middle. This is the average inventory you're carrying over the period, every 3-week period, 3-week period, 3-week period. So this is a sawtooth model, very simple model. But in reality, you have to see lots of things. As I said, that the cost per order, total order cost, and my carrying cost are the two things that I have to balance. So if I balance it, this is a calculus problem basically. And if you optimize the size of the order Q by minimizing the total cost, this is a calculus problem. Optimal order Q you can obtain by minimizing the total cost in such a way that subject to increase in the marginal increase in the carrying cost exactly equals to the marginal reduction in the order cost. Once you do that, then you'll get the optimal inventory size, which is right here. Optimal inventory size. So this is a calculus problem. If you solve this problem, you will find, so notice over in this graph, as the order size increases, my total order cost will go down, right? It's going down. But also simultaneously, as my order size increases, what happens is my carrying cost goes up. As long as I can offset, my costs over my carrying costs and my order costs, the point where they intersect, I can keep building until then my inventory. And that, if I keep doing that, my total cost will be down. This will be my EOQ. EOQ, or the economic order quantity. And beyond this, if I keep stocking more inventory, then my total inventory cost will keep increasing. So my EOQ is obtained by solving this calculus problem. If I solve this problem, I will come to the calculations over here, but not the calculus problem. I'll come to the result over here. But the point is that remember that if the marginal order cost exceeds the marginal carrying cost of the inventory, then increase the order size. But if the marginal order cost is less than the marginal cost of the inventory, then decrease the opposite is true. So keep that in mind. And we'll see that as we move. This is the solution. Once you solve that calculus problem of, setting the marginal carrying costs over here, the marginal carrying costs equal to the marginal order cost, then if you minimize the total cost, the EOQ result you will get as Q equals square root of 2 times the sales times the cost per order over the carrying cost. This is the solution, calculus solution to the EOQ. This is how you determine the EOQ. Square root of 2 times sales times cost per order over carrying cost. You can see over here that, if the cost per order is more, this is going to increase the Q. If the, carrying cost is less, this is going to increase the Q. So either way, it goes over here. And let's apply this model and see how we can apply it to real life. So let us say that we are selling cereals, okay? And you sell 600 cases of cereal annually. So my sales is 600 cases, and my order is for 40 cases in each shipment. My order size is 40 cases in each shipment, okay? And the annual carrying cost per case is $5. Per case to carry, it cost me $5 per year. And the economic order quantity becomes what? That is 25 cases over here. So here, when we say that 25 cases, the EOQ, 25 cases, 25, you can find out either Q, you can find out our cost per order, you can find out carrying cost, anything, your sales, as long as the others you have. So you're selling 600 cases of cereal, each consignment is 40 cases, that is the size of the order, and the annual carrying cost per case is 5. So 5 times 40 is 200 per year is your annual carrying cost. So here, basically, when we plug in the EOQ example, 2 times 600 times the order cost divided by my carrying cost of $5 is my EOQ. The question is, what is the cost per order? How much is the cost per order? This is the question. So if my EOQ is 25 cases, it is given, and my carrying cost is $5 per case, and my sales are 600 cases per year. So I just solve for this equation Q, which is 25, equals square root of 2 times 600 times cost per order, or order cost, over $5 carrying cost. And I can solve for my cost per order. It is just by squaring this, I just squared these here. So Q squared equals, I remove the square root sign, and it is 200 times 2 times 600 times order cost divided by the carrying cost of $5. If I solve this, so order cost is, you will get as, if you solve this, you will get $2.60. will be a cost per order. Okay, so this is how you get it. It is, just a issue of plugging in this example and plugging in the numbers over here, and you'll get whatever. Either thing you can get cost per order, you can get carrying cost per case, you can get your, how much sale, or most importantly, what is the EOQ? If you know your sales, you know your cost per order, you know the carrying cost, and what is the EOQ? How much should you order? Economic order quantity. And it is always good to know that. You're always good to be at this point in your curve. So that way, you will have your optimal order size, the Q. In this case, it is already given to you as 25 cases. Okay. So that's what it is for inventory management. Remember, there are some tips over here. When your carrying costs are high, based on the EOQ model, basically, when your carrying costs are high and your order costs are low, it makes sense to place more frequent orders and maintain higher levels of inventory. If your order costs are high, you will want to make larger and therefore less frequent orders. Common sense. And it goes with your EOQ model. Inventory levels do not rise in direct proportion to sales. As sales increase, the optimal inventory level rises, but less than proportionately. That's why you have a curve. You see the curve and all the curves. So remember that in real life that happens. And just the EOQ. And most importantly is, if you go into cash management, if you treat cash as an inventory, cash management strategies and the models, we'll not discuss models over here, but cash management models like the Miller-Orr model or the Baumol model, they consider cash as an inventory item. And they apply the EOQ model there, and you get the Miller-Orr model or the Baumol model, Sawtooth model, those kinds of things. You can do the same for cash. Just treat cash as inventory and apply the EOQ model, and it'll be the same. You'll get, the proper strategies from that. So that brings us to the third important aspect of working capital, and that is cash management. Now, remember that idle cash sitting with you, it does not pay interest. So it serves to move the money from cash accounts to short-term securities so that you can get some interest. Banks, for larger corporations, they will offer you sweep programs where they take your cash, includes your demand deposits in bank. Okay, the accounting definition of cash is what you have cash on hand plus your bank account, whatever you have. So good commercial banks, they have good sweeping programs, and some of you might be knowing it. They give you good market rates every night. They sweep your balance and get better interest rates for you. But they require a minimum deposit. And then you have concentration banking is another strategy people use. If you have scattered, units every place and you have multiple units in different places, then it's important to have a concentration bank where you have one main bank and then you have subsidiary accounts. So in retail places, other retail places, you keep, giving the basic bare minimum needs and keep the rest in your concentration bank. And that way, it saves a lot of problems for other units. So they don't have to go borrow money if they are short, because you can supplement it from the concentration bank, from the central bank and central pool. So it helps you, and lots of benefits you get from it also. And then logbox system. Logbox system for most of these banks, if you use concentration banking, then they will also offer you logboxes. What are these? The collection tools. You will have, whenever you send your checks or whenever you pay, you're paying your bills, you will get, pay PO box, Verizon, pay Verizon check and PO box, so and so. So the whole idea is that you're sending it to a lockbox. And the bank, it is very close. It is in local areas, these PO numbers. So regional areas where you have regional banks and your bank accounts for your supplier, and they will collect your money. Verizon will collect your money there, and then If the bank can collect it locally, it reduces the collection time and processing time. We'll talk about those things. So different forms of cash payment these days you see, EFT, electronic fund transfers, they are used. The automated clearing houses, ACH, if you have your bank mortgage and this and that, and then through the clearing houses, it can go directly, Fedwire, chips, international for international banking, Fedwire, chips, clearing house, interbank payment systems, and these are, although they are very small, they are smaller compared to ACH and EFT and all those, but the amount is quite a bit because they are used internationally, So it goes in trillions. It's a big amount. Then in international cash management, you have, typically it's the same thing like lockbox arrangements where you have regional in every country, where you have your business in that region. For example, Europe, different places you have your business. Then in London, you'll have a central bank. And then you have retails in every country where you have your business, and then the central London bank will use the rest, they will compensate the others in times of need. And it helps that way. Also in international cash management, hedging is very important for currencies. So, and the banks doing this, they know. So you can hedge your dollar payment. You can pay for a yen through dollar, and the bank will hedge your dollars, the value of the currency, and tell you that this is the right time to pay, this is a bad time to pay. It helps a lot. Nowadays in the currency market, they use a third option. You hedge. So this was, you don't have to just between here and yen, you just don't hedge your dollar. You can hedge through a third currency. You can hedge through a euro. So it goes, there's so many different ways. This international banking is a very, very, very pronounced thing these days, especially with business becoming global. Compensating balances, same thing with concentration banking. These are other ways of doing it. Again, same thing you can use to larger international things. You can use compensating balances, where you compensate for your currency differences and those kinds of things. But important over here, we'll go into details of collection and floats. The concept of float is very important. What is this float? So, first of all, we have to understand that there is a lag. When we make our payment, from the time we make our payment till the time the cash is actually on hand, or from the time we receive a check or receive a payment versus a check from a supplier versus the time that we actually see the money in our account. So both ways, there is a lag. With electronic systems, things are becoming more real time. However, the fact still remains, even now, we still find that, you made your payment for your credit card and the money has moved from your bank already. But on the credit card side, it records after so many days. And they tell you that it might take 2 or 3 business days. Where is the money in the middle? It is floating. So that is a float. And businesses, they made use of these floats quite a bit earlier, and even now they're making use of it. Somebody is making money on this, and a lot of money. Okay. And I remember coming up with this back in 1995, 1996, when this electronic digital cash was first coming. And I wrote a paper on this, and the editor told me, I said, floats are going, floats are not going to be there. And the editor says that I don't believe you. You can't have that. That is not right. And he was right, although I, made it less harsh on him. and he published the paper, but I can see what he was talking about. Even now, I can see the float moving around, and you can also see it. Somebody is making the money on that, and a lot of money. Every day, if all of us are making payments, and these payments are not reaching the place on real time, then what is happening in the middle? Somebody else is making money, right? And that is because of float. So time exists between the moment a check is written and the moment the funds are deposited in the recipient's account. And this time spread is called the float. Okay. And what happens is, depending upon which side you are on, you can always take advantage of these floats. So payers attempt to create delays in the check clearing process. Okay. So that the payment float is there and the money is sitting in their account still, and they can still earn interest, or they can make use of that until it finally clears. On the opposite side, the recipients attempt their best to remove these delays and clear the checks fast. So this is the opposite side. They want the collection very fast. As a credit, if you're extending credit and they're receiving payments, you should collect it fast. And the sources of this delay, we know that it is, to mailing, if it's a check, the time to mail the check, or, for the time for the recipient to process the check through the bank, or the time for the bank to clear the check. All these things, they add to the delays, to the lags. Okay. So if you want to put it like this in a picture format, so you have two kinds of floats. One is if you're a supplier and you have collected a payment check from somebody, then there is the availability float, which works opposite for you. Because of lag, the funds from the checks that you receive from your clients are not available to you. So that is a no-no, that is a negative. You want to collect fast. The other side is the payment float, which is if you're writing a check and it hasn't cleared for the customer, for whoever you have written the check, then you have the money still sitting in your account. You can make use of it. So the difference between the payment and the availability float is called the net float. And depending upon your net float, you can still hedge your bets. And we all do that all the time, even, when we are writing checks or doing this, doing that, we make sure that the float works to our advantage. So it works like this. The check is mailed, check is received, there is a mailing float over here, then the check is received, and then the check is deposited. Between that, there's a processing float. And after the check is deposited, the check clears, there's a cash availability to the recipient, and the check clears, or the check is charged to the payer's account. Either way, whatever it is. But we discussed what happens. And you want to make use of the net float should be positive for you all the time, not negative. Otherwise, you'll be in trouble. Hopefully down the road with digital, everything digitized, everything will become more real time as we move along. We are heading in the right direction. Still there is a way to go. So we talked about concentration banking, where we create a concentration account. Customer makes payment to a regional collection center where they transfers funds to an account at a principal bank. So you have regional collection centers, and then you have principal bank. All the funds are transferred to the principal bank, and then depending upon your needs, they are dispersed other places wherever the need is. So that is concentration banking, concentration account, very useful. Typically, banks that offer concentration banking also offer lock boxes, PO boxes. So where I explained to you the system, how it works. You're writing your checks to a PO box number. So the customer sends payments to a post office box, and the local bank collects and processes it. And then from the local bank, it will go to your concentration account, wherever it is. The whole idea is to reduce the float, the time. So here is an example. There is financial implications of all this. So let's apply this concept. First example is, how much value would be added to a firm that could permanently reduce its collection period by 2 days? if the daily collections average $10,000 and the opportunity cost is 5% annually. And we'll see how it is 20K over here. So my total collections, first of all, we want to know how much value would be added to a firm if we could reduce this collection period by 2 days, okay, because of lock boxes and stuff. Okay, and the size of the collection average, the total number of the total size of the collection is $10,000 on an average, and the opportunity cost of that, what you're missing, is 5% per year. Okay, so my total collections are increased if I buy 2 days. So 2 times 10 is $20,000, right? And my interest rate is 5% annually. So per day, it is 5% divided by 365 days of the year. That is per day interest. So I'm increasing my collection by $20,000 a day, 2 days, and 5% divided by 365 is my interest per day. So the present value of this interest will be what? $20,000 times 5% times the interest rate over here, whatever we have, discounted by the daily interest rate, which is 0.05 times 3 divided by 365. So that comes to 20,000 over here. So that's how it works. Just apply the present value concepts over here. Example 2 is lockbox receives an average of 2,000 checks a day, right? So 2,000 checks per day, the lockbox is receiving, and the size is for each check is about $1,500. You have to see what is the size of the check on an average that you will allow to your lockbox, because you have to pay a fee for the lockbox. So your fee should be less always. Typically it is not that much, but still you have to see. So 2,000 checks a day, average check size is 1,500, daily interest is 0.02%, and the lockbox saves 2 days in mailing time and processing time. And the cost per check for handling is 50 cents per check. The bank charges 50 cents per check for the lockbox. So what is the net savings from this lockbox arrangement for you? So you will see here that the extra collection float that you're getting is, because 2 days you are saving, each size of each check is 1,500, there are 2,000 checks. So extra collection float that you're creating is $6 million for your business. So first question is, what is the daily return of this extra float earnings? Obviously, you have $6 million per day, and the daily interest rate is, 2.02%, means 0.0002, right? So that's what it is. That equals $1,200 per day. This is your daily return on the 6 million because of this earning, quite a lot. And the bank charges per day are what? 50 cents per check. So 50 times 2,000 is $1,000 per day is the bank charge. So obviously this is a go ahead, right? Because my bank charge is $1,000. My daily return is $1,200. My daily return is more than my daily cost. Therefore, it is a go ahead. Net savings from this lockbox is A minus B. That is my daily returns minus my daily charges. That is $200 a day. So this is my lockbox example. And then investing the cash also is very important. Idle cash is sitting. You don't want more and more idle cash to sit. Otherwise, it will be an inventory problem for you, because when a firm has excess funds, you can invest the surplus in so many securities in the money market for short-term financial assets. And most instruments in the money market have considerably shorter maturity of less than 1 year. And obviously, it is shorter period. So gauging risk of default over shorter horizon is much easier. And you have almost no risk over here as the interest rate fluctuations increases more and more with the maturity. So if the maturity is less, then the fluctuations are less. So you take your money and the banks help you, actually, commercial banks help you to invest it. When you invest in short-term financial assets that become your marketable securities, nowadays you can do it, the whole idea is to reduce the risk and keep it liquid. So T-bills are the most liquid, most easily marketable, and it's zero risk, guaranteed. Most, you can have T-bills and weekly the treasury issues T-bills and maturing in a month, quarter, semi-annual, annual. They can have all kinds of maturity. Commercial papers are from private companies. So you have to look at the riskiness of this. This will be more risky. And then you have to look at the ratings, bond ratings, and those kinds of things. And then the CDs, again, CDs are, the banks also, commercial banks and now local banks also, they offer you CDs for different maturity periods because the interest rates are less. And then repo agreements. Basically, they will give you the dealer, whoever is doing giving you the bond, they will say, okay, we'll give you with an understanding that we'll buy it back. Okay, we'll buy it back at this price, at a higher price. So the yield is already given with the interest that you're paying because it's markup, you're buying back. Okay, so that's why repo, it is called repo agreement. So go through these are all definitions, very simple. And there are so many alternatives these days, keeping on evolving every day as we go. But my humble suggestion would be not to get caught in using your business account for day trading and those kinds of things. Let the sweeping accounts do the job for you. It is easier rather than, it depends how much risk you want to take. Yeah. So, okay, so we stop here at this point. I'll stop share and I will